Welcome to Market Brief After Hours. It was another turbulent session on Wall Street today, with equities struggling to find solid ground. We saw escalating tensions in the Middle East, persistent inflation concerns, and a lot of wild swings in the energy sector. Let's break down exactly what happened out there.
It really was a roller coaster of a session. The broader theme today was uncertainty. Markets are highly reactive right now, caught between short-term stabilisation efforts and deep structural concerns, particularly regarding energy supplies.
Let's start with the major U.S. indices. It looked like things were going to be much worse earlier in the day, but we did see some intraday recovery. How did the final numbers shake out?
That's right. The major averages trimmed their losses by the closing bell, but it was still a red day across the board. The Dow Jones Industrial Average extended its losses for a second consecutive session. It fell 0.44%, dropping about 204 points to close at 46,021. What's wild is that the Dow was actually down nearly 500 points at its lowest point today.
That is a significant intraday swing. What about the S&P 500 and the tech-heavy Nasdaq?
The S&P 500 showed some resilience. It was down about 1% earlier in the session, but managed to claw its way back, slipping just 0.27% to close at 6,606. The Nasdaq Composite followed a similar trajectory. It was down as much as 1.4%, but ended up declining only 0.28% to close at 22,091. Tech stocks definitely faced some profit-taking today. For instance, Micron Technology dropped 3.8% as investors decided to lock in gains after a really strong run that had been driven by robust earnings growth.
The volatility seems deeply tied to the energy markets right now. Oil prices were spiking again today. What is the latest on the ground that is driving these energy costs so high?
Geopolitics is entirely in the driver's seat here. Brent crude briefly surged above $119 a barrel earlier today, which is the highest we've seen since July 2022, before settling at $108.65, up 1.2% for the session. US West Texas Intermediate actually slipped 0.2% to close at $96.14.
What caused that pullback from the intraday highs?
We heard some comments suggesting potential efforts to reopen the Strait of Hormuz, which provided a bit of temporary relief. However, the underlying risks remain incredibly elevated. Iranian strikes have damaged Qatar's LNG infrastructure, which effectively removes a massive chunk of export capacity. As long as those supply chain disruptions are front and center, energy costs are going to keep upside momentum in the equities market severely capped.
Speaking of the broader economy, we also received some domestic data today regarding the labor market. It seems to be telling a different story than the volatile stock market.
It absolutely is. The US labor market continues to show remarkable strength. Initial jobless claims actually fell by 8,000 to 205,000 for the week ended March 14. Economists had forecast 215,000. So despite all the macroeconomic headwinds and geopolitical strife, layoff activity is subdued. Job growth might even be rebounding.
But that good news on the labor front is somewhat of a double-edged sword when it comes to interest rates, right?
Precisely. Strong economic data, combined with those earlier spikes in oil prices, reinforces the fear that inflation is going to remain sticky. As a result, Treasury yields are rising. The two-year yield climbed 6 basis points to 3.803%, which directly reflects heightened sensitivity to Federal Reserve policy expectations. The 10-year yield also edged up to 4.261%, though the 30-year yield did decline slightly to 4.842%. Tighter financial conditions are just limiting overall risk appetite.
Let's shift our focus overseas. If the U.S. markets were volatile, the European markets seem to be taking a much harder hit. How did the major European indices fare?
It was a broad and heavy sell-off in Europe. The Stoxx 600 dropped 2.4%. When we look at specific countries, the weakness was universal. The UK's FTSE 100 was down 2.49%, Germany's DAX fell 2.56%, and France's CAC 40 declined 1.76%. In Italy, the FTSE MIB lost 2.28%, and Switzerland's SMI dropped 2.4%. The only sector that managed to hold on to any gains was oil and gas, while mining shares led the broader decline.
Europe is obviously much more sensitive to these energy disruptions. How are their central banks responding to this?
They are walking a very tight rope. Europe is highly dependent on imported energy, so the prolonged Middle East conflict is a massive threat to their economy. Central banks across the region, including the European Central Bank, the Bank of England, the Swiss National Bank and Sweden's Riksbank, all kept interest rates unchanged, which was expected. But the outlook is shifting. The ECB actually revised its inflation outlook higher. They now project 2026 inflation at 2.6%, up from 1.9%, and lifted their 2027 estimate to 2%. The Bank of England also struck a cautious tone, warning they could tighten policy if inflationary pressures persist, especially given the softening UK labour data, where unemployment just hit a 5-year high of 5.2%.
And the Asian markets? Did they follow Wall Street's lead?
They mirrored the global weakness entirely. Japan's Nikkei 225 took a massive plunge, down 3.38%, even as the Bank of Japan maintained its policy rate at 0.75%. South Korea's Kospi fell 2.73%, heavily dragged down by chip giants Samsung and SK Hynix. The weakness in the South Korean won actually prompted government warnings after it briefly breached the 1500 level against the dollar. Over in India, the Nifty 50 saw a steep 2.89% decline, which was exacerbated by a 5% drop in HDFC Bank following the resignation of its chairman over governance concerns. Finally, China's CSI 300 fell 1.61% and Hong Kong's Hang Seng dropped 2.04%. The prospect of prolonged energy disruptions is really souring the global growth outlook.
We are going to take a quick break. When we come back, we will dive into the currency markets, check on precious metals, and highlight the biggest individual stock movers of the day. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the broader indices and the geopolitical factors driving today's volatility. Let's pivot to the Forex market. It sounds like there was some significant movement with the US dollar and major currency pairs today.
It definitely was. Let's start with the euro against the dollar. Euro/USD staged a really strong recovery from its recent lows, closing up 1.19% at 1.1588. It traded in a wide range between 1.1443 and 1.1616.
Does that mean the euro is breaking out of its recent downtrend?
Not quite yet. While there was a sharp rebound in buying interest, the pair remains capped below some key resistance levels. It is still trading below its 50-day simple moving average at 1.1731, the 100-day SMA at 1.1686, and the 200-day SMA at 1.1675. Because it's still below those moving averages, the broader medium-term bias remains under pressure. Immediate support right now is down at 1.1443.
What about the British pound? Did it see a similar bounce?
It did, and an even stronger one. GBP USD posted a solid bullish reversal, closing up 1.31% at 1.3431. The pair actually moved back above its 100-day SMA at 1.3397. It spent the session testing resistance near the 200-day SMA at 1.3437 and the 50-day SMA at 1.3508. This suggests that short-term momentum is really improving, though the broader trend is still a bit mixed.
And looking at the Japanese yen, which has been under intense pressure lately, did it find any relief?
It did find some relief today. USD JPY retreated from its recent highs near that critical 160 level. It closed down 1.33% at 157.69. However, despite this pullback, the broader uptrend for the dollar against the yen is very much intact. The pair remains comfortably above its 50-day SMA at 156.49, its 100-day SMA at 156.33, and its 200-day SMA down at 151.93. Today's move looks more like a short-term correction within an established bullish trend.
Shifting to commodities, it was a rough day for precious metals. Gold and silver took a significant hit.
A very sharp drop indeed. Gold closed down 3.51% at $4,649. This is a significant bearish move that pushed prices below the 50-day SMA at $4,963 and the 100-day SMA at $4,578, signaling a real shift in short-term momentum. It is, however, still sitting above the 200-day SMA at $4,061, which provides some longer-term support. Silver followed a similar path, sliding 3.43% to close at $72.78. Selling pressure is building there as well. It fell below its 50-day SMA at $86.43 and is currently testing support near the 100-day SMA at $72.39.
Let's wrap things up with today's market movers. Despite the broader market struggles, there were some massive individual stock swings. Who were the big winners today?
The standout winner today was Five Below. Shares jumped more than 10% after they reported Q4 net sales of $1.73 billion. What really excited investors, though, was their forward guidance. They forecast 2027 revenue between $5.20 billion and $5.3 billion, and the midpoint of that range easily exceeded Wall Street's expectations. Planet Labs was another massive winner, surging 14%. They delivered better than expected fourth-quarter results, actually breaking even on an adjusted basis when analysts were expecting a loss. Plus, their revenue guidance for both the first quarter and the full year came in above forecasts.
On the flip side, who took the biggest hits?
Alibaba had a very tough session. Its US-listed shares fell 7% after reporting revenue of 284.8 billion yuan, which missed estimates of 290.7 billion yuan. More concerning was their net income, which dropped a staggering 66% year-on-year to just 15.6 billion yuan. Kinsale Capital also struggled, declining 6% after Jefferies downgraded the stock from hold to underperform, giving it a price target of $312. Finally, drone company Red Cat fell sharply, dropping 11% after missing earnings expectations. They reported a loss of 17 cents per share, which was wider than the 15-cent loss analysts had penciled in.
It certainly paints a picture of a market where investors are being highly selective. With the conflict in the Persian Gulf showing no signs of a swift resolution and central banks maintaining their cautious stances, it sounds like we should expect this volatility to persist across all asset classes in the near term. Thank you to everyone tuning in. If you find this useful, please follow Market Brief After Hours. See you next time.